Supply and demand, the fundamental economic concept where the quantity of a good or service supplied by producers and the quantity demanded by consumers interact to determine the market price. Gross domestic product, GDP, the total monetary value of all goods and services produced within a country's borders in a specific time period, usually a year or a quarter. Inflation, the increase in the general price level of goods and services in an economy over time, leading to a decrease in the purchasing power of money. Deflation, the decrease in the general price level of goods and services, often leading to increased purchasing power but potentially causing economic problems. Consumer Price Index, CPI, a measure of inflation that tracks changes in the average price level of a fixed basket of goods and services purchased by a typical household. Producer Price Index, PPI, an index that measures the average change in selling prices received by domestic producers for their output over time. Monopoly, a market structure in which a single seller or producer dominates and controls the entire market for a particular product or service. Oligopoly, a market structure characterized by a small number of large firms that dominate the market and often engage in strategic behavior. Monopolistic competition, a market structure where many firms exist, each offering a slightly different product, allowing for some degree of product differentiation. Perfect competition, a market structure characterized by many small firms producing identical products, with no barriers to entry or exit. Fiscal policy, the use of government spending and taxation to influence the overall level of economic activity. Monetary policy, the management of the money supply and interest rates by a country's central bank to control inflation, stimulate economic growth, or stabilize the economy. Central bank, a financial institution responsible for issuing currency, regulating money supply, and overseeing a nation's banking system. Federal Reserve, the central bank of the United States responsible for implementing monetary policy and regulating the banking industry. Exchange rate, the rate at which one currency can be exchanged for another currency. Balance of trade, the difference between the value of a country's exports and imports of goods. Tariff, a tax imposed on imported goods to protect domestic industries or raise government revenue. Subsidy, financial assistance provided by the government to businesses or individuals to promote economic activities or achieve specific policy objectives. Elasticity, a measure of how responsive the quantity demanded or supplied of a good is to changes in its price or other determinants. Market failure, a situation in which the free market does not efficiently allocate resources to achieve the best possible outcome. Marginal cost, the additional cost incurred when producing one more unit of a good or service. Marginal revenue, the additional revenue generated from selling one more unit of a good or service. Laissez-faire, an economic philosophy advocating minimal government intervention in the market economy. Keynesian economics, an economic theory that advocates government intervention in the economy during economic downturns to stimulate demand and employment. Classical economics, an economic theory emphasizing the importance of supply-side factors, such as production and savings, in determining economic growth. Opportunity cost, the value of the next best alternative that must be foregone when a decision is made. Comparative advantage, the ability of an individual, firm, or country to produce a good or service at a lower opportunity cost than others. Utility, a measure of satisfaction or well-being derived from consuming a good or service. Crowding out, a situation in which increased government spending reduces private sector spending due to higher interest rates. Gross national product, GNP, the total monetary value of all goods and services produced by a country's residents, regardless of where they are located, in a specific time period. Human capital, the knowledge, skills, education, and training of the workforce that contribute to economic productivity. Gross national income, GNI, a measure similar to GDP, but it includes net income earned from abroad. Black market, an illegal or unregulated market where goods and services are traded outside of formal channels, often to avoid taxes or restrictions. White market, the legal and regulated market for goods and services. Economic growth, the increase in an economy's production of goods and services over time, typically measured as a percentage change in GDP. Recession, a significant decline in economic activity, often defined as 2 consecutive quarters of negative GDP growth. Depression, a severe and prolonged economic downturn characterized by high unemployment, low consumer spending, and a lack of investment. Fiscal deficit, the situation where government spending exceeds government revenue in a given period, leading to government debt. Trade surplus, a situation in which a country exports more goods and services than it imports. Trade deficit, a situation in which a country imports more goods and services than it exports. Elasticity of demand, a measure of how sensitive the quantity demanded of a good is to changes in its price. Elasticity of supply, a measure of how sensitive the quantity supplied of a good is to changes in its price. Market equilibrium, the point at which the quantity demanded equals the quantity supplied, determining the market price. Capitalism, an economic system characterized by private ownership of the means of production and market-driven decision-making. Socialism, an economic system characterized by government ownership of key industries and central planning. Communism, an economic and political ideology where there is collective ownership of the means of production, and the goal is to achieve a classless society. Wealth inequality, the unequal distribution of assets and wealth among individuals or groups within a society. Poverty line, the income level below which an individual or family is considered to be living in poverty. Cartel, a group of firms or countries that collude to control prices, production, or distribution of a particular product. Rational choice theory, an economic and social theory that individuals make choices that maximize their own utility or well-being, given their preferences and constraints. For more knowledgeable videos, please subscribe our channel.